Madhav Dhar, who's managing partner at GTI Capital Group, joins in with his view on the markets. Madhav, it's a global rally, and India is enjoying that bit of advantage as well. What do you make of the kind of run we've seen thus far? We are halfway through to the 11,000 mark, and it's been a spectacular year for India.
Yes, it has, but as you pointed out, I mean, it's been a spectacular year for global stocks. So I don't think India has had any material outperformance, but it's been a good year worldwide and for India as well. And it's largely driven by a steadily improving global economy, some receding of political fears, some receding of fears that the changes in important administrations, especially in the US, would reverse global trade and have an adverse impact on sentiment. So I'd say it's a little bit of continued liquidity, increasing growth, some recession of global fears. And I think within the Indian context, the GST bump has been digested, the demonetization bump has been digested, there's been some marginal reform, some big reform in terms of recap. So I would say minor structuring, reform positives, offsetting some negative stuff, continued liquidity and rising growth, which is a fantastic, deadly combination. And things are good and certainly better than a lot of people thought they would be for this year. So far, so good.
Madhav, morning. Nikunj also joining in. So how would you characterize the current market setup? The consensus view on the street is that markets have run ahead of the actual earnings recovery because of liquidity, and when earnings will actually recover, stock prices may not go higher because they've already moved them in anticipation of an earnings recovery.
Yeah, I'm in the uncomfortable position of feeling like the consensus, which as a natural contrarian is not a comfortable place to be. I think there is some truth to that, but I think if you look at history of bull markets, they tend to have three phases. I mean, it's not always the same, but it's similar, which is they start from the ashes and all you have is PE expansion, and it doesn't make any sense. And that happened in India about 5 or 6 years ago. Things started moving up, couldn't figure out why. And then you start to see the economy pick up, but the earnings not quite coming through. The PE keeps going up. And the last stage of the market is a euphoric move where the PE and E both go up. Both earnings and PE rise at the same time. And the market may not go up that much more because the PE is already there, but it does tend to go up. And that's usually a blow-off phase where even the cautious people get converted. And I don't think we're quite there yet. So I think valuations are extended. I'm very concerned that liquidity around the world is starting to recede. Maybe not materially, but it's starting to recede. US rates are rising, British rates are rising. So I think the 8-year run we've had since 2009, instead of one-way liquidity accommodation globally, is over. But it's over at the margin, and earnings will probably compensate for it for a little while longer. So this is a very old bull market. It's aging, it's tired, it's big, it's long, but it's probably not over. That's my best sense of where we are. And as far as India is concerned, I mean, I don't think it can sidestep any kind of major global correction. It certainly won't. But I think we are, frankly, in a 15, 20-year bull move. And we are just sort of getting started, in terms of the duration of that move. I mean, prices are high, valuations are extended, worries me a lot. But history will also tell you when an economy truly gets going, you really don't want to get out of the way, even though it looks uncomfortable from time to time. So I think India is in that spot. And I think it'll be typically Indian stuff, grudging positive reform, earnings will pick up. We are at a point where margins are still very low. even though valuations are high, so margins could surprise, earnings could be disproportionate relative to sales growth over the next 2-3 years, and suddenly India will not look so expensive anymore. So that's my sort of broad, sort of messy view, which is it's a little scary, it's a little late, the party's going on, it's 1 a.m, but it's not time to leave. That's my sense.
That's some rocking party, Madhav. That's all I've got to say. But, talk about your concern points. And I'm intrigued at your view when it comes to private banks. You've called it a crowded trade and you're saying that you don't own them. Why is that? Do you believe it's time that you're going to see some correction step into private banks, or because you believe that there are better opportunities in the market? So therefore not private banks and maybe something else?
I am old enough and battle-scarred enough that I think you don't have to have an opinion on everything. So if I don't feel strongly about something, you just walk away. You don't have to justify why you don't like it. It's just, the necessary, I don't feel the enthusiasm to own things that are so crowded, so clearly demarcated in terms of what their growth and value proposition is, and there is no margin for error on valuation. So those things tend to bother me. That's, that's the way I approach things, which is the prism of, is something undervalued? Is it improving? And are most people missing something? So in a way, the private banks are the exact opposite. They're expensive. Everybody knows the story. They're great managements, and they've had a great run. So it's the opposite of the way I think long-term investing truly works. But I'm also aware that there are different philosophies of investing. Growth investing wins. You buy great quality companies, hold them for 20 years, and that seems to win. It's just not my style. It doesn't mean it won't work. So you just get to know what swing fits you, and you go with that swing. So that's not my thing. So I like some of the public sector banks, which are not great companies, not great managements, but they're cheap, they're restructuring, they're getting recapitalized, which is, I bought them a year ago in anticipation of some of this. And I think the financial tailwind in this country is just massive, despite what we've already seen. I think next 10, 15 years will be incredible, and I think it'll shock people. It already has in the brokerage area. One of the things I think last time we talked about was what was being underestimated is the change in wealth holdings, which is real estate and gold, two competing assets to financial assets, are dead, absolutely dead, not wounded, but dead. And that changes the flows into financial assets, which means everything from NBFCs to brokerages to stock market investing to insurance. So that whole trend is monstrous. It's not new, it's not original. NBFC is a crowded trade, but you don't want to step out of a massive secular trend. So to me, the massive secular trend is India growth for 10, 15 years, financial asset proliferation in India for 10, 15 years.
Right.
So you want to be in the intersection set of those two big trends.
No, absolutely.
And you can play it many ways.
Madhav, I spoke to Russell Napier a few weeks back, and he said he would not buy a public sector bank anywhere in the world unless it was being privatized. Now, you're keeping your conviction with PSU banks. You bought these banks about a year back. I understand that, it's the turnaround story in the works. That's the hope trade with investing in these banks. But you're keeping your faith largely with the big brands, the large cap PSU banks. What is the opportunity set that you're seeing within the wider gamut of PSBs? Or is it just a selective few who can garner more market share and gain the most from this turnaround?
I think except for the top 1 or 2 or 3, I'm not willing to take even a risk-loving person. I'm not willing to go below that level because I have no sense. What you want to buy is a cheap stock that improves dramatically both in valuation and earnings perceptions. What you don't want to buy is a risky situation that goes bankrupt. So I'm willing to take a serious position in something like State Bank of India. I don't want to get into naming names, but something like that, which I think is cheap. I think it's had very decent management. Obviously, it cannot compete with the private banks for a variety of structural and personnel-related things in terms of freedom of movement. But I think all of that is changing at the margin. I don't think these will be, truly unfettered private banking mindset within 2 years. But I think they will be freed up a lot more at a time where valuations are very compelling, and they will start to lend again. And just the nature of what has happened in terms of recap, the bankruptcy code, what we've gone through with Kingfisher and all the press, I think all those factors are going to free up these banks to do a few things at the margin that will surprise very positively in earnings, and valuations are not compelling. So I think the percentage change in owning these stocks, I'm betting that they will be higher than a similar position in a private sector bank. So that's the extent of my bet. These are not 5-year trades or 10-year trades, but they're 2 or 3 year trades.
Fair point.
I'm 1 year into it.
Okay, fair point. Now, Madhav, what we've done is that we've put your checklist out, a conversation which we had offline, and so that our viewers can really benefit from the thoughts and the kind of checklist which you follow. Now, Madhav essentially says that he believes on endorsing rate of change when awful could become bad or rate of change is going to be constructive. He also gauges market sentiment as a clear indicator of what the crowded trades are and where the ownership patterns are. Now, valuations, according to Madhav, it is a necessary condition, but it is not a sufficient condition when he is looking at investing into a stock or into a particular company. So, Madhav, I've got your checklist out, and if you have to apply this checklist on what really qualifies, if you have to filter sector companies through this checklist, PSU banks is one. What else? Because when you say that you look at market sentiment, the market sentiment, I guess, for all the good businesses is very crowded, whether it is private banks, NBFCs, consumer staples, or good old brand owners.
No, listen, that's a fair point, and there's very little place to hide. So I'm as I said earlier, I'm afraid it's late in the game. So there is nothing obvious. There's no 3-on-3. I talked about it a while ago. When there was this taper tantrum and India was selling 14 times earnings, rupee panicked to 70 in September 2013. And you could bet that we were at the absolute low point of everything, about the growth cycle, about politics, about corruption. You had 3-on-3. You had compressed valuation, massive fear in the market, and it was very easy to predict that things would improve. You had 3 out of 3 on my checklist. And those are the time you really have to wade in. You can't second guess yourself. You have to step in big time, back up the truck and buy everything. And very rarely, I think every 5-7 years it happens, you get 3 out of 3, either in an entire market or in an asset class or in a subsector or a stock. Very rarely does it happen. And you're absolutely right. I mean, I look around, there is no 3-on-3. There is no situation where something is cheap, is improving, and most people don't get it.
So how does one connect?
So I like infrastructure. Okay. I like some...
Now, my question to you is that you are of the view that we are in a 10-12 year kind of in bull market, and yet you are struggling to find what really could be as a good investment proposition. So if the long-term view is so great, what is restricting you from going all in?
Because the odds are we'll get some correction somewhere here. I don't know next week or in 6 months, but I think things are frothy and extended, and there will be some kind of correction, some kind of scare in the market, and that will provide a fresh opportunity for the next 2 or 3 year phase. So that's my most likely guess, that we've gone on too long straight up without any kind of material pullback, and something will happen out of somewhere that will provide that opportunity, because life is not this straightforward, and it's been a little too good for a little too long. So I think we are going to get hit on the head somewhere here. So that's my concern. I can't quantify it. I can't even predict what it might be. But when everybody is in the market and you're at 24 times earnings, something tends to happen that scares people. And I think we're overdue for something.
Until then,
but that doesn't shake my conviction that if and when that happens, you should buy it.
Yeah, absolutely. That goes
Sorry, go
without
ahead.
saying. You know, we've all learnt our lessons from exactly a year back when you had that demonetization low. But just very quickly, wanted to get in some sector views as well. And you believe up until that correction happens, or when the correction happens, you like large cap realty, and you believe that offers a good opportunity. Now, large cap realty, to my mind, is only one or two names at best. What gives you conviction about them?
Conviction is a similar kind of feeling. It's very hard to quantify in the sense that you have a sector that is so beaten up, finally, after being the darling for the entire bull market from 2002 to 2008-9. It's been beaten up. Stocks are down to 80 or 90% from where they were. They've been written off. They have all kinds of debt issues, and it's off the radar screen. So that is a necessary precondition. I like that situation. It's hard to quantify these things on valuation, so you have to be a little more creative about what you think the fair value of something like this is. And that also interests me because it's a little not obvious. And then you have to see, well, how will life unfold in the next 3 or 4 years? And I'm not sure things are going to get much worse. I'm not sure things are going to get better. But again, going back to Nikunj's point about rate of change, when real estate goes straight down to starts flatlining, that's positive rate of change. And it's happening at a time when I think the stocks have overcorrected dramatically, and any kind of stabilization will lead to a pop. And now some of these stocks are up almost 100% off the low from a year and a half ago, but that's nothing in the grand scheme of things. So again, these are trades, and these are, I don't make 2-3 month trades, these are 2 or 3 year trades. So this is a little bit, to me, like buying riskier public sector banks, that there will be an upside surprise when things just normalize a little bit. That's the extent of the argument. You don't have to make some great case of a real estate bull move, either in volume and prices, and I don't believe there will be one. But I think stocks could be up 4 or 5 times off their lows, and it'll look like a little blip on a chart, frankly. It's like what happened to NASDAQ after the bust in 2002. These stocks moved up 5-6 times, and you could hardly see them on a chart because they went down that much. Yeah. So I think there's a trading opportunity lasting a couple of years in some of these companies.
No, it's always prudent to buy them when the margin of safety is higher. But thanks very much, Madhav. It's been an exhaustive discussion. Thanks very much for sharing with us your insights and your thoughts. Interesting to know that you like PSU banks, selective PSU banks, and selective real estate stocks at these levels.